market that's suddenly become a heck of a lot more fraught as the major averages have their biggest decline since March 16th. What do we do with the defense contractor, usually so steady? Take L3Harris, the company that was created when L3 Technologies, a company we like very much, merged with another one we like very much, Harris Corporation, last year to create a major player. Roughly a year ago, I started recommending this one because it's involved in all sorts of high-tech areas. Integrated mission systems, intelligence, surveillance, reconnaissance, space, avionics, electrical warfare, precision engagement sensors, drones, all the stuff of modern-day warfare. Plus, I love the merger. And I very much believed in management's ability to deliver on their cost-cutting targets. Initially, the stock roared higher, as it should have, but then the pandemic came along. And through the whole world went into disarray. We know L3Harris is in good shape. The company reported a terrific quarter last month, even as their tiny commercial aviation business is struggling. Everything else, though, good shape. Normally, I feel confident recommending a defense contractor in an election year because historically both parties love throwing money at the Pentagon. But between the pandemic and the protests, we're in a very unsettled moment politically, which is why we need to dig deeper. So let's check in with Bill Brown. He's the chairman and CEO of L3Harris Technologies to get a better sense of how his company's doing and where the industry is headed. Mr. Brown, welcome to Mad Money.
Thanks for having me, Jim.
Okay, so, Bill, when I look at the lineup here, integrated mission systems, space and airborne systems, communication systems, aviation systems, aren't they really the pick of the litter of what a defense budget's about in the 2020 timeframe?
You know, we certainly think so. You know, as a bigger company, L3Harris, combination of L3 Corporation and Harris Corporation, of course, we're a bigger player, broader set of missions, broader set of technologies, you know, very good cost synergy. We're starting to see revenue synergies coming through. The team is doing just a fantastic job. We have a great leadership group, dedicated employees, really focused on the mission, working hard through these unprecedented times in this pandemic. I couldn't be more proud of what they're delivering for our shareholders.
All right, now, historically, we've seen Republicans in favor of some big programs that involve massive hardware. We've seen the Democrats pretty much involved with what you want. In an election year, should our investors be worried that somehow that will change given the strange climate we have going into the election?
You know, look, Jim, it's a question all investors are asking. I don't think they should be worried. In fact, we live in a very dangerous world. You know, the threats are becoming higher, greater, not lower. You know, we see aggressive actions by China, by Russia, by Iran, by North Korea. You know, those threats are out there. If anything, they're getting worse. And I think what you're seeing in the defense budget is a pivot towards near-peer competition, away from counter-insurgency, the wars in Iraq and Afghanistan. And when you hear near-peer, you got to think China. And going against China requires technology. It requires delivering platforms to the fight. And those platforms have to get connected. They don't fight by themselves. They have to get connected across space, airborne, ground, maritime. Connecting those platforms means resilient networks, communications links, communication through jamming, ISR capabilities, all of the things that really are in the sweet spot of this company called L3Harris.
Now, you are competing against China in a way. It's not just who has tanks. It's not working like that, which means you have to spend a lot of money in R&D. How does that hit your bottom line?
You know, look, we're a technology company. You know, 40% of our employees are technologists, scientists, engineers. You know, and I talk to people, I talk about us being a technology-based company that sells into defense and national security markets. In fact, the competition of the future, a warfight of the future is going to be based on new technology. Technology is only being developed today. You know, we're right at it. We're investing almost 4% of our revenue in R&D, in company-funded R&D. It's at the high point across all the defense space. You know, we're aggressively leaning into this because technology, it really is going to drive the future.
Okay, so now you've been making these divestitures, which I like. Sometimes maybe it's better to be lucky than good. You got rid of airport security and automation before really the end of air travel, didn't you?
Well, airport security is a very good business. We just didn't think it fit very well with the portfolio that we're creating at L3Harris. So we said early on, we said we would shape the portfolio and focus on businesses where we want to invest our management time, our dollars, our resources that really drive strategic value to our shareholders. And that's the path we've been on. So we started very early. We said we would divest 8 to 10% of the revenues of the company. You were through about a third of that. So about $500 million has been sold. 3 transactions, 2 have actually closed, and others that are in works and will happen over the course of the balance of this year and into next year.
Bill, Would you ever consider getting out of the part that is commercial? Because it did ding your quarter. And, you know, look, as someone who likes pure plays, I don't want to be levered to that industry anymore. Is it worth being levered to it?
Well, we're taking a look at the whole portfolio, not really commercial or defense. We're looking at all of the businesses that we're in and taking a clear-eyed view of what businesses really drive value into the future. So you're right, we did take a hit this year in the commercial aerospace business. It's not a very big piece of the portfolio. Commercial as a whole is only about 5%. It's split between commercial aerospace and public safety. You know, those businesses were down this year. Commercial aerospace would be down something like 30 to 45% this year. Public safety down about 10%. So we did see a step back in our top line growth, about 2 points off the top line. So growing 3 to 5% this year instead of the 5 to 7% we originally targeted. But we're able to offset a lot of the earnings impact from that through cost efficiency, through cost synergies and productivity benefits. So we really trimmed our EPS for the year by about 20 cents per share, which is less than 2%. So we're able to absorb the downturn in the revenue through better focus on cost.
All right, one last question. On page 12 of your investor briefing, which was done in May, and things are happening so fast, I have to ask this. You have a great chart which says shareholder-friendly capital deployment, talking about dividend increase, share repurchase. Is everything on the table now because of the way the stock market worked out, and something you put out in May 5th no longer, let's say, no longer is viable?
No, that's still very current. We're generating a lot of free cash flow. So even though we reduced our earnings per share for the year, we held our free cash at $2.6 to $2.7 billion. We still see ourselves growing to $3 billion with the free cash flow in calendar 22 through cost savings, through growth, through cost synergy, working capital improvement. And we're going to deploy most of that cash back to shareholders. Today, we have a very, very good balance sheet, less than 2 times leverage. So we're well capitalized. No pension payments required in the next couple of years. You know, and we're focused on integration, on divestitures, on the things that make this company better. So we're really not focused on M&A at this point, which gives us a lot of cash to deploy back to shareholders through dividends and share buybacks. So we said we would do about $2 billion this year in share buybacks. We did $0.7 billion in the first quarter alone, while another $1 billion coming in Q3. We pay a very, very attractive dividend. We raised it by 10% in August of last year, 13% in February. So we're up 25% on our dividend just since the closure 8 or 9 months ago. So we're very attuned to giving those cash back to owners.
All right. Thank you so much, Bill. That's a great story. I'm glad to hear that. And I feel like the commercial's under control. That's what matters to me. Bill Brown, Chairman CEO of L3Harris, LHX. Thank you so much for coming on Mad Money.
Thank you, Jim.
Look, is the dividend intact, growing? You've got cash flow, but you always have the possibility it is an election year, although his company's in the sweet spot for both. Mad Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.